So last Friday, we've taken questions from all of you on Twitter, which I said I will answer in this YouTube video update just like the last time. And so here goes. Of course, I could have done this over the weekend. It was a nice, good long weekend, but we've used it to do many other things and get back to the markets. And I'm recording this just ahead of the Fed. So it's the 3rd of May and the FOMC meetings tonight. But when we talk of broader trends, mostly they remain intact irrespective of events. And so that's the interesting thing. We'll see if something changes. Of course, I'll continue to monitor and update on those on Indiacharts. But based on what we know and the information in place, let us get on and hit the questions. Now, it's the first one here from Paresh, which is, what is the risk reward like on non-direction option writing? Now, there's an interesting article. I've posted it back here. If you go to Indiacharts, you'll probably find it. Okay, so you simply have to go to the educate yourself section. You can find those links here, or you can find it if you click on market analysis, you'll find an educate yourself link. And then if you scroll down and click on load more, eventually you'll reach this point, get your FNO basics and analysis. So this gives you insights on how you should go about approaching the futures and options market based on how I think about things. There's not no one's approach is the only approach. It's your knowledge, your experience that, gives some insight. So surely you will take away some things from this, especially in the option side. What strike should you buy? What strike should you sell? How to use delta? That's sort of explained down here. And since his question was around the risk reward for option sellers, sellers essentially looking at selling slightly out of the money options would look for a 4% kind of per month ROI if they can do it correctly. Which requires one, getting the view direction right, because I don't like the idea of non-directional sell calls and puts both. I know people do that, but I usually like to be, if you can, judge the trend and, just sell the opposite side. That improves your odds along with what I've explained in this article and choosing your strike. So that the combination improves your odds so significantly that you should probably think of nothing else. So go and read it and get a better insight on that. The reward, like I said, can be a 4% per month kind of, or 5% per month kind of thing on option writing. The risk is usually half of that, So if you start losing, half of that in terms of premium going up, or if prices just surpass the strike price you have written and you exit, which may happen once or twice, or max, hopefully not more than twice in a 12-month period, you're sort of able to manage around it. The next question here is, you spoke on this space once on BHEL. Now, of course, in this he's asking me about the BHEL long-term wave count. I think that was one of the questions either by him or below. And let me just look at the BHEL long-term chart. So the interesting thing about BHEL, and since I've been tracking and writing about it as what we call the value wave model. The value wave model is something where I coined it based on where we are in the wave structure and where we are in the long-term, value growth momentum cycle of the company. You sort of get an idea of, what is going on. Say, for example, when prices were down here, which is when I started writing about it in May of 2020, around 20 rupees plus or minus, the book value would have been much more, maybe 50, 60 rupees, if I'm not wrong, or more. I don't remember the exact number, but something like that. So you're at a discount to book, and more important than that is, like I said, the wave structure. So after having peaked, you see this very nicely channelized 5-wave advance that peaked in 2007. After that, it's gone into a long bear phase. The long bear phase, multi-year or multi-month bear phases can end up being complex. When they are complex, we mark them as WX, YXZ, which is also 5 waves down, but they're not impulsive. By impulsive, we mean none of the moves up and down within this structure are 5. So when you're going up here, you see a series of 5s up, 1, 2, 3, 4, 5, pulls back, then 1, 2, 3, 4, 5. That is impulsive on the way up. But on the way down, we see a series of 3 waves, 3s, and that is what we call as a corrective bear market, and we mark it in this way. Now, that's basic insight into Elliott wave analysis. Z is usually the last, which is why we use this lettering of WX, YXZ. So usually after Z, there's nothing left. And I was waiting for many months here for, Z to show up as maybe complete. And sort of that's the point where we reached down here. The trend line of the lows, was sort of hit. And as we reached Z, we are able to conclude. So even if I take a parallel of this, and we fall below that. So we call that a throw under, where we have this panic reaction below the parallel channel. That was a good point of, considering are we done with most of the panic reaction long term. And so from there, we've been slowly progressing. That tweet was essentially saying that, you identified that this could be Z, and now we are breaking out of this long-term channel. So what does it look like? So I'm not going to really give a outlook apart from my view, because of course we don't give advice. We are not an advisory service. We can't really tell you to buy or sell something. But what we do observe here is a long-term second wave, which is a very deep retracement, completed in Z, which in Elliott wave terms means you complete a bearish structure and should start, beginning to show impulsive moves higher again, which should then complete 5 waves. And so far I've been marking it as 1, 2, 1, 2, trying to. So we have not yet completed 5. That is for sure. And when you complete 5, you will be able to count a proper 5 in sequence. So this is something we'll keep doing now for years to come. I'll keep trying to mark 1, 2, 1, 2, 3, 4, 3, 4, 5 till it's really completes a 5 wave structure, and then we know it's complete. Until it doesn't complete a 5 wave structure, we work with the presumption that, yeah, okay, this is in an uptrend and it is bullish, unless it really breaks one of the previous swing lows and violates the impulsive logic. Okay, now of course there are rules and guidelines to do that in Elliott wave analysis, but that's what we do, or that's what I do full time, trying to figure these things out. So very interesting chart, beautiful breakout. In fact, for those who study technical analysis, what you actually get is not just a breakout, but you also got a pullback. If I really zoom into this, sorry, we've just zoomed a bit out. Yeah, you see right after this breakout, prices pulled back, testing the breakout trend line, and then started to move up again. So that's also a good sign that you actually done a pullback to the breakout point. The breakout point proves to be true in terms of holding that level, and that's a sign of strength. Now the next thing is we will be watching for is surpassing the previous high at 91.45. So this is where it is. The next question, yeah. So he asked WXYZ long term, and I'll show. So I've shown that views on if we can see a major decoupling moment and what the West sees a crash and India outperforms. So that has never happened. Therefore, it's very, very difficult to say that you can decouple. Of course, here his question was relating to China, similar to what happened in China in 08-09. My chart here shows that, well, China was also in a severe bear market if you use the Shanghai composite. So it peaked here in 2008, October of 2008, and was declining all the way down to October, November of 2009, sort of where the commodity markets also bottomed out. The US market, of course, bottomed in March. Now you can say that, okay, this was the decoupling. Now this kind of decoupling is what we call late stage intermarket divergence. So for example, here, if US tops out first and the China tops out 1 month later, that's just a topping process. It is not a decoupling. It's just a temporary divergence between two markets in the same asset class. And that's sort of what we witnessed at the bottom as well. For a couple of months, the US was still falling and China started to recover. So that doesn't mean that they've decoupled. It simply means it's an intermarket divergence and marks an overall trend reversal coming across markets, because then after 2009, you would have found that, all of the markets were going up together. So that is why I said decoupling has never happened. We've had short periods of breakaways between two markets. Say, for example, Nifty and the S&P. If you broadly look at the chart, the top one is the S&P, the bottom is the Nifty. Well, they do tend to move together many times, but two things happen. One is the intermarket divergence at the highs, something that I just discussed on China. So this continued to make a new high, but India stopped making new highs after October. And so there was an intermarket divergence. And then after that, eventually both are moving together down, then both are moving up, both are moving down, and so on. Now, once again, as we get closer to the end of this phase, we start seeing an intermarket divergence. Where exactly? And that started to happen in after January. So what we noticed here is when this fell to a new low, we did fall, but we didn't fall to a new low. And then once again, we are moving higher, and now they are beginning to move higher. And then we are falling throughout this phase. So first of all, there's this divergence. Okay, so this is the intermarket divergence marking a reversal between the two markets. Now here, neither of them have made a new low, but we did see a divergence where the US still moved higher and we did not. We continued to drop all the way till this point. And then from here, both are moving up together. Now, this also becomes a point where people say we are decoupling. This also is a point where people start saying we are decoupling. But broadly speaking, it was a temporary phase, and eventually both markets tend to move together. The reason for this is global liquidity is singular. All markets are moving up and down on the same global liquidity, which is flowing from one market to the other, or one country to the other. The outperformance or underperformance of one market versus the other can happen because, say, for example, if the dollar is falling and asset managers favor emerging markets, then they move money out of the US to EMs. That doesn't mean the US collapses, because 2003 to 2008, the US underperformed. The Nasdaq did not make a new all-time high, but emerging markets like India went up 6-fold or 8-fold. So, huge outperformance because of simply money flow. But that did not mean that one market goes down and the other goes up. So, I don't think there will be decoupling. If India does well, then you'll probably just see a situation where the US does less well. Now, for all the problems that we hear around the US, if India continues higher, the US could be much more slower, much more, something like this. It could waste a lot of time. Even if it gets back to the previous high, you will find that we significantly outperform. So this is something that can happen. I don't believe in the decoupling concept till we really see it, simply because global liquidity is what we say global. Now back to the question. The next one here is, what do you think about the Seng Tech Index from an Elliott wave point of view? We have published a chart of the Seng Tech Index a while back, more than a month back, and it actually is 5 waves up, which means if we fall in 3 waves, the next move should be again upwards, which means the Seng Tech Index is actually showing a bullish setup. So here's a chart itself of the tech index. Let me see if I can switch to a weekly. That will show it more clearly what we are talking about. And this chart we published on Indiacharts a while back. If you simply look at this phase, what you end up seeing is a clear 1, 2, 3, 4 and 5, and then a pullback. Now either this pullback is complete or we are still consolidating in a more complex WXY. But broadly speaking, this should be wave 1, this should be wave 2, and once this is complete, we should be starting off in wave 3. This will look like a big inverted head and shoulders pattern, and that's what we think. So really good setup, much better than our own tech index for sure. Tell me about the Indian liquidity in terms of RBI policy, because it's all about liquidity driven market. Well, Indian liquidity is twofold. One is RBI was trying to tighten or do away with the excessive liquidity it injected during COVID, just so that inflation stays under control, which is sort of what they have slowly been doing. But they're saying they support growth, which is why they did not raise rates very fast or early. And at the same time, they have paused ahead of the Fed. So right now, I think clear indication, if you simply look at the bond market, in fact, today's bond market was a big one to really watch. And I've been eyeing it all day. So let us just, quickly move to my bond market chart here. So here you see the 10-year yield. In fact, it's almost dropped to 7%. Since morning, it has been, falling. It was 7.03 in the morning, then 0.201. Now it's almost 7.00. It is 0.06. It's close to breaking below 7%. Market closes, I think, probably closed at 5 o'clock. So yeah, this is the net closing. We've lost more than 10 basis points because the previous close was around 7.10. So 10 basis points exactly. And this is a big breakdown from a triangle, which is what I've been calling for since January, that this is a topping pattern in the Indian bond market, yields basically. So bond market goes up, yields go down, and bond yields are headed much lower. So if you take interest rates falling as a cue from this, then that should expand your liquidity in terms of credit availability at lower rates. That is what is likely to happen. But broad liquidity, of course, the RBI is going to tighten a bit of the excess which is in the system so that it doesn't get inflationary. That's about it. But they will probably simultaneously make more credit available at lower rates, which is then balances the whole thing out. Next one, can you tell me about BHEL stock? Has it got delisted? Some loss, like blah blah blah. Means if you're delisted, will not get any money or equity. Well, that is how it is. Once a stock is delisted, especially if it's going into closure, I don't know what the status is, but if it's going into closure, equity investors are the last ones to get paid. Everyone else gets paid first, whether it's the debt holders, the various layers of debt who is given priority. Equity is the last one in priority. So there's always a chance for a company that's gone bad that you end up losing almost everything on that. So I don't know what the status is. Will somebody else buy it out and get it relisted? Will it join a bank? Those could be possible good fallouts of something like this, but I have no idea. I'm not following up on that story. But equity investors, you should know, are the last ones in line to receive any money, if at all. Can Coffee Day Enterprises surprise within a year? I have no idea. A friend of mine suggested I look at that chart a year ago. The chart kept getting messy and then I stopped looking at it. So that's all I can say on that. We have 3 target for this move. Good question. I will fully give out that number in the next long short report. But you're right. It's either 3 or 4. Let me at least tell you that much. It's not a conclusive third wave. I have a preference to say that the Nifty is in a fourth wave. So let me at least open the Nifty chart, and you get a sense of how I'm counting it. See, all I'm thinking about is that the entire rally from 2020 bottom is 5 waves up, and then it's complex. This entire correction to me is a complex correction, wherein I've marked it as a WXY kind of structure, WX and then Y, and then now we are starting something new. But complex structures are more likely fourth waves of some degree. Okay, so rather than third. So this is my sense of it, that we are done 4 and we are starting a 5. That doesn't reduce its intensity on the upside, because it's still going to be a major impulse and develop into 5 waves longer term. So in the meantime, wait for the long short report to really come out. Your valuable feedback on silver for upcoming times. I think precious metals are in long-term bull markets. There's no doubt about that. And the reason really being that is, if I look at my RMI indicator, by the way, the RMI indicator is going to be on the new Strike platform. Strike is the new proprietary software tool that we are really developing. I'll give you a preview for those who have really not seen it. But let me just open gold and silver. Okay, so when I look at silver, and actually for long term we'll move to a monthly or a quarterly chart. These are the RMI cycles, the RMI indicator, and here it is crossed over to bullish in the month of December itself. And December tends to be a seasonally good period for precious metals. And from there, on the quarterly chart, we may see some whipsawing, but it's actually held the quarterly averages, and it's also held the 61% retracement of this entire rise that we saw in 2020. So very good, interesting, setup, and that also combines with gold, because gold has also done a meaningful retracement, not 61, maybe 50%, but the monthly has crossed over to the bullish side. So both gold and silver have done that on the monthly cycles, and which is why I think they remain longer term bullish. They have also gone through this long complex corrective phase, like I just discussed WX, YXZ and BHEL. Something very similar has already happened here. And from there, what I think is they have done the initial moves, wave 1 and wave 2, retracing 61%, and probably starting a third wave, which is very, very meaningful. So it goes into a phase where broadly will get accepted as something having changed. Between 1 and 2, the doubts are still open. When 3 starts, everybody starts recognizing that a bullish phase has started. So that is sort of what I think is happening to the precious metals. So very interesting space to be in. And hey Rohit, where do you see the current impulse get halted for the correction to begin for the whole up move from 16,828? First of all, only when we complete 5 waves. That's something which has not yet happened. So if we actually move to a Nifty chart, what we'll actually see here in the very, very short term, and since you have sent me an intraday chart, is I think some people may I think this may be a triangular structure, and so actually trying to take this as 1 and 2. And now for a correction to set in, I have to be able to complete 5 waves. Right now we are in the third. It's just pulled back here to this intraday trend line, probably continue higher to the point where it will complete 3, then there may be a pause, then a 4 and a 5, and then maybe you'll get a correction or consolidation that can last for a while, meaning couple of weeks. So till that point, I don't think you'll get something very, very significant. And even after a 5-wave advance, because we are in a bull market, I don't think you're going to see any significant retracement. You'll get some retracement of the rise. It's not like you're going to, fall off a cliff. So I think that is pretty clear in my head. In fact, here again, just like we saw in BHEL, at the smallest degree, you broke out of this channel, pulled back, test it, and then take off to the upside. So very, very beautifully done by the market itself. We have nothing to do with it. We can only observe, identify, and point out that, see, this is what is happening. So we are in 3. 3 is also not complete, because even if wave 3 and wave 1 have to be sort of equal to each other, if we simply look at the size of this move, this was approximately 5.6%, and if we have a similar move to the upside, we end up at around 18,550, and this is just the third wave. So let's presume third is equal, and then you get a fifth from there after some pullback. I'm just making a rough assessment. Eventually you could end up somewhere around 19,400 before we even get our first consolidation. Okay, so that's, I think, sort of giving you an insight of what we are really thinking. And hell has to break loose for this to not happen. There is no signs of hell on this chart or any chart, specifically in India. All the fear surrounds the US, so that is a completely different ball game. Please review PSE long-term chart and views on it. So the public sector index essentially is I'll take the NSE one. Okay, I like the NSE PSE index. It's done a good second wave. It's attempting to break out into a third. Okay, so very broadly putting it, going to a quarterly chart, there's some things happening. First thing is we are doing a multi-year breakout. Okay, so after 2008 or 10, when most of the PSU stocks and many sectors like power, capex, capital goods, etc. topped out, this index has been in a sideways trend. That's something that we see even more clearly when we say take the BSE index. The reason I didn't take it is I like the count better over here, but let's just take that for visual purposes. Okay, so you'll get an idea that, see, this is the NSE index doesn't have so much history. So after this last bull run, okay, this one, once we peaked here, what we've actually seen is this long consolidation phase, right? You can put it inside a down channel, or you can put it into a double bottom over here. And now we are breaking out of this down channel. Okay, so this is the start of a new bull phase. And within that new bull phase, so again, W, X, Y, X, Z, same thing, complex, long term, whatever this larger wave count is, I don't know, it's a fourth, typical of complex. So let's just presume fourth, and then we started something new, which is 1, 2, and we are now inside third. So within the third, we can go into what this breakup is. It's this minor 1, 2, 1, 2, or whatever, but long third to go. It's got a long way to go. So this is how the PSUs are, which is why they've barely gotten started from what we call the value phase, right? This was the value phase. High dividend yields, low PE ratios, nobody cares. And even when it goes up, everybody tells you don't buy PSU stocks, they're dogs. Well, they are all regretting it right now. Now everybody is recommending PSU stocks. So that's the funny thing about markets. What is your long-term view on UNSP? I actually don't know what is UNSP. Now let me presume for a moment that he meant United Spirits. Been through a long boring phase. Longer term, you'll find that the stock appears to mostly be going up. Pulls back, then goes up again. Deep pullbacks, and then now the pullbacks seem to be getting smaller and smaller and smaller and smaller. But generally speaking, it's moved higher, so it doesn't look like a problem. That's all I can say. What I don't like is the long waiting phases. Now, of course, sometimes a new trigger comes up in a company, and then the waiting phase becomes short, and then it suddenly takes off. Will that happen over here? You really need to check, on what is happening fundamentally. But broadly, the chart has made higher highs and higher lows long term. Nothing has happened to say that anything has gone wrong. So everything seems good. That's about all my generalization can be on that. Where do you see gold moving in the short term and long term? I already mentioned about silver. So very similar views on gold. Gold is also bottomed out very, very long term. So if I just look at the RMI cycles for gold, what we end up seeing is, see in dollar terms, what I'm really thinking is this is again the start of a new impulse. We are just waiting for the Fed thing to happen tonight. Otherwise, the daily RMI just crossed over to the bullish side yesterday. On at least on the raw, we have the raw basic RMI, and then I have two variations to it. So I think very close to okay. So it hasn't done so yet. Maybe it's close to, maybe today it may be doing that on the live price. That is why it came to my mind. We'll see tomorrow. So post Fed, if we do get a bullish crossover on the RMI, we'll be looking at wave 1, 2, 3. If the third and first wave can equal each other, we start talking of 2200. Then we look at the weekly, and then we look at the monthly. So if you look at each of the time frames, the weekly RMI is also sort of positive. We didn't break the averages here. Again, a good sign. So the 2040 averages here held as support, and then it's moved higher. The best one I really like is the monthly, just like I said in silver, because here with this whole pullback, the RMI actually pulled back also, went all the way below zero, and it's given a fresh buy signal over here. And here also on the monthly, it has pulled back, taken support on the 20-month average, and again started to rise. So very clearly longer term also, this is 1, 2, and 3 starting. And even in the big picture, I'm debating with myself whether this is 1, 2, 3, 4, or whether this is Z and this is 1 and 2. I don't know what it is, but either case both point to multi-month advances here, because the long-term trend is clearly breaking out. We've already surpassed this high marginally, and after surpassing it, we are sort of consolidating near these highs. So it's just been one long consolidation. Usually a shakeout near the highs is previous investors who got stuck here getting out over here, is how it's talked in technical terms. Some people may even call this a cup and handle. Not wrong, because when you reach a previous top and then you form a sideways, or usually in a cup and handle you want a downward channel, but even if it's sideways and then you break out of that, you sort of start a new major trend. So we'll watch out for that. We're very close to this point. We in fact just touched this trend line of the last two highs and then paused over there. Moment we surpass it, I think everybody will start recognizing that you have a breakout. So that's what I think. How are the metals shaping up from 12 to 24 months point of view? Your views on the next commodity cycle. So commodity cycle, if you simply look at the Bloomberg Commodity Index, okay, or BCOM as you will find it on investing.com, we see the first 5-wave advance over here recently, but we are also seeing this sort of decline appearing 5, which is happening because of oil. So we're trying to figure out, is this because I thought probably we are close to the worst being done at these lows. We're waiting for that further confirmation, because even despite the recent oil rally and copper rally, we didn't see an across the board metals rally, right? Most of the commodities are flattish. But I think we're getting to the point where it should reverse. Oil is the only odd guy out. So I think this fall is being driven more by oil, and oil could, result in this being one more X and Z down and then only completing. But I think base metals probably turn earlier, and I'm watching out for that. Don't have a confirmation yet. Though I can say on copper we are almost sort of confirmed. I mean, the good news is that copper didn't go below 61% retracement, whereas oil is back to the fourth wave of lower degree, but not touched it exactly at $68 to $65. That was the range. It touched 68 and then didn't touch 65. So here when we look at copper, this bottom here was 61% retracement of the previous rise, which is good. But this advance is very slow and, with long consolidations, which doesn't give you great confidence right away. But it can happen in commodities. So then I again start looking at, okay, what is the RMI doing? What is it doing on the monthly? Where it may have actually given a bullish crossover, right? So that it has done. We are watching whether it holds the retracements and then starts a fresh move higher. That would further add weight to the idea that we are done here. So this is what it is. The recent rally has triggered the RMI on the monthly, but we are consolidating right now, seeing whether the averages hold and we can start a fresh move to the upside or not in the short term. That has not yet happened. Thanks, Partha, for the comment right there, and down to the last question. I'm hearing a narrative that the top has been made or would be made on Monday. Well, that's already proven wrong since market shot up on Monday. So is it happening today? I don't know. So far, we've only pulled back to the 20-hour average. We are waiting for the FOMC meeting. So let's further discuss this tomorrow. But in the way market has risen, it will be hard to fall. That's correct. Back to 16,800 and lower. Is the narrative justified? The narrative always changes. I mean, see, the narrative so far was that the US could go into a recession. If rates are higher for long, everything will fall apart. And that's sort of the narrative I was also talking of till December. But as we got to January, I've sensed that the bond market is reversing and the dollar has already peaked in last year in September. And so narratives should change. The beauty is the narrative is still not changed in everybody's mind, because I still hear the recession talk in the US. And in an inflationary cycle, the patterns can be slightly different. So I'm not taking those conclusions seriously, or rather I'm considering them, but not yet moving with them. The markets are definitely not moving with them. So the narrative will slowly shift towards what we discussed earlier, the falling bond yields in the Indian market. We even seen a big drop in yields last night in the US. See what happens after the FOMC meet. Same with the US dollar and the USD INR, which is USD INR is still not falling along with yield. So it's been stable. But if the dollar index starts its next leg down, probably all currencies would join it lower. And that's the next thing to really watch out for when it comes to watching the global market. So I'll just switch to the US indices, US template, and here we are looking at the dollar index, which is sort of been bumping around, trying to move up. I've been thinking that this bounce is simply an A, B, C. If that is true, it should start the next leg down, but we want to actually see that. The moment that happens, you'll see a gold breakout. If it does that, so all of this would then sort of conclusively create the new narrative, which is that the previous phases of rising rates and strong dollar are over. It's already happening on charts, but people are not talking about it, which is why the narrative is narrative simply means what people are talking about has not changed. Bond yields also have peaked here. They again rose, did not make a new high on the 10-year US, but did make a new high on the 2-year US. I posted that chart in March, that the intermarket divergence between the 2-year and 10-year are indicating a peak in US bond yields, and that's sort of what happened over here. And I think this is an impulsive decline. So it is wave 1, wave 2, waiting for wave 3 down. And that's why today's meeting is going to be important. But before I go, here's a brief preview. I said that in between the video that I'll just show you what we've been working on. One of the more popular indicators we've had recently, something known as the daily swing, captures many short-term highs and lows in the market. And so, of course, you have to learn how to use it. So we've actually added this here and would update every day and maybe even live as we go online, and many other things, many other data points that you'll completely not find anywhere. This is one of them which I've been keeping and tracking for decades now, which is breadth. And nobody has breadth charts. We have the entire historical all the way back to 2000, which you'll be able to see here. I'm just showing it to you from 2012 to 2023, and the breadth is of course spiking up. That doesn't necessarily mean you're at the end of the move. We always put that along with the Elliott wave structure also, but also look at different formats of breadth. So here I'm looking at the 40-day average. This has not reached the top end of the range, and so there's still room between the 20 and 40. And so this is just two tools. There are multiple things here: heat maps, sentiment indicators, many other things. I'm not going to tell you everything till we launch out, but this is the look and feel of what's going to be a massive data analytics platform, not just technical data, but also fundamental economic, which you'll be able to scan through, search, set up alerts, and create your own home page where you can actually go out and, look at the main things that you want to watch. Customizing your homepage and having that template is, one of the greatest things that you can actually do, which is this template. And you're actually able to, move the blocks around and, change them as you want, or go to a full screen mode if you really want to do that on any of the data points. So enjoy. This is coming soon and should be launched in a couple of weeks. Thank you. So those are all the questions. I've answered whatever was here. Hopefully it's given you enough insight. And for more, continue on to the Indiacharts website. Subscribe to the daily posts or go to a YouTube channel and podcast, both Indiacharts. You type Indiacharts anywhere, you'll find us on Spotify, you'll find us on Apple, you'll find us on YouTube. And I publish, like this video will be on YouTube as where you're going to be watching it. And simply click the subscribe button and like this video if you did, so that helps more people follow it. That's the way to do it. Show your likeness by liking it, and see you all next time. Thank you.